think that's where you need to watch, right? I mean, if you look at, I think the line in the sand for the Fed, for monetary policymakers in general, is that I think to understand the situation, just to take a step back, I mean, the fiscal response that we saw to COVID created an excess surge in demand that obviously is creating inflation now. To understand the problem the Fed faces, that's where everybody focuses. But there's the other issue that, monetary policy, both coming out of the GFC and then out of COVID, basically created a massive surge in debt. And that debt exists and has to be refinanced. And we live in a world where that has to happen. And you need to have, enough liquidity globally to satiate that role. And for that to happen, credit markets need to be functioning properly. And most of that borrowing happens in the wholesale money markets, collateralized lending. And so I think if you see those markets start to break, and I don't hear a lot of people talking about this, and I'm not saying we're there yet, but if the Fed starts to see pressure there, they will back up quickly. And I would just point to what happened in 2019 when the repo market really went bananas, how quickly Powell pivoted then. So, they're dealing with a true dilemma in terms of having to beat inflation. But, as we see, we can argue about how much liquidity is driven by regional banks in the U.S., but the fallout from that, I think, is putting pressure on that other issue the Fed has to deal with, which is, there's a lot of debt out there that needs to be refinanced. And, we're looking at a bigger crisis if the liquidity doesn't exist to do it. So I think it's a very interesting situation they're in.
By the time that collateralized loan market starts to crack, will it be too late? And will the Fed be behind the curve? And actually, will the U.S. economy go into recession ahead of any action from the Fed to provide more liquidity and to cut rates?
I mean, that's a tough question. And I'm not saying that market's going to crack either. What I'm saying is that I think that's the line in the sand. If you look at excess bank reserves, if you look at money market flows, if those get to if you start to see liquidity drive to a point where those markets start having trouble, the Fed will be forced to act. Now, the good news is if they start to see it, I think they will be forced to act. My general view is that if you look past everything that's happening right now, and just kind of focus on liquidity in general, we've been in a drawdown cycle globally as the central banks have been tightening to fight inflation. Eventually, that's going to turn up again. It's going to turn up because they really have no choice. And I think when that does happen, that risk assets will do well. And so investors need to be, it's a tough environment because basically we live in a world now where you go from crisis to policy response to crisis. And that's the water you have to navigate if you're an investor. But eventually, I think the Fed will do a pivot to some degree that actually gets risk assets moving again. And I think that's something a lot of people aren't talking about when they just focus on the here and now.
Jeff, there have been a lot of examples over history of central banks hiking into a downturn. But in terms of what we're looking at this time, it felt like the economic cycle would be different. We have a Fed hiking, it would hold for a bit before eventually cutting. Now, if we're still talking about a hike, but then potentially a cut later this year, and we've had a couple of guests on already saying it could cut by the end of this year, what's the point of hiking in the first place?
Well, it's a tricky thing they have to get right? I mean, there's an argument that if they don't hike, that creates more panic because people are like, wow, things must really be bad if they're turning so quickly. So I think what you can expect, probably I'm with the consensus 25 basis points, but probably dovish language out of the Fed. So, I think they'll do maybe the 25 bip hike, but they'll be a little dovish. But if you look at, just look at the implied policy rate in Fed fund futures market, from like March 8th to March 15th, the reversal you saw. I mean, I think at one point prior to all this mess, in regional banks in the U.S. that you were seeing, I think they were expecting like another 100 or 110 basis points of hikes to get to peak rate. Now they're implying 35 basis points and actually cuts later this year. So I think that massive turnaround in market expectations speaks volumes about what literally happened when Silicon Valley Bank went down. And I mean, you don't raise rates as quickly as the Fed did without breaking a few things. And now they're in a tricky situation. But I'm optimistic, and I think there are reasons to be optimistic if you're a long-term investor. I want to be clear on that.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.